Well, hi and welcome. My name is Casey Boland, and I'm a wealth advisor with HCM Wealth Advisors and CPAs. I'm joined today by Doug Johnson, who's our senior investment strategist, and Dan Rinck, who's a research analyst with HCM Wealth Advisors and CPAs. Welcome to our webinar. So if you'd like to ask a question, please go to the bottom of your screen and click on Q&A. And there you'll have an opportunity to submit your question, and we'll do our best at the end of our webinar to answer your questions. All right, in today's discussion, we're going to cover a brief review of 2023, what's ahead in 2024. I know everybody's distracted by Taylor Swift here at the moment. And then also we're going to have a short discussion about behavioral economics, which is a fascinating field of study of the financial decisions we make. So why do we have a picture of Taylor Swift here? She was the person of the year, I guess, for Time in 2023. And I know it's kind of a corny analogy, but Taylor Swift has this song that relates more to what happened in the economy and the stock market last year. Okay, I know it's a bad joke, but the shake it off. And clearly, consumers did just that as consumer spending, which is about 2/3 of the economy. It remained strong in 2023, despite the risk of a potential recession. And we saw the stock market rebound and bounce back as well. Now, it's interesting about Taylor's. She was not the reason the economy didn't go into a recession, but the high demand, it wasn't the reason we were able to avoid it, but the demand and spending during that 6-month tour of the year, it's estimated that the total economic impact for Taylor Swift's 6-month tour, close to $5 billion. And the Federal Reserve had a great stat on this. It estimated that the Swiftie economy is bigger than the economy of Aruba, and added 0.04% of the U.S.'s economic growth of $13 trillion during the 6-month GDP period of time. So, all right, let's move on. So what was the big winner? Let's review 2023. What was the big winner in 2023? Growth stocks, more specifically, the Magnificent Seven, which consists of Meta, which is Facebook, Alphabet, which is Google, Microsoft, Apple, Amazon, NVIDIA, and Tesla. Those 7 stocks help propel the S&P 500, which is that purple line here in the chart, up over 26% in 2023. And the performance of those 7 stocks, it was not indicative of the performance of the majority of the companies. So if you looked at trying to understand what the average stock in the S&P 500 did during 2023, there's a security called the S&P 500 Equal Weighted Index. And the equal weight means that if you invest $500 into the equal weighted index, every company gets $1, meaning equally. It gives us a pretty good idea of how the average stock in the S&P performed during the year. And the average stock was up about 13.7%, which is about a little over half the return of the overall market. Now, that's a pretty big gap between the average S&P stock and what the S&P did itself, but still solid for stocks nonetheless. Now, some people believe, though, when you look at this year, 2024, it's going to be the year of the 493. So those other 493 stocks, not the Magnificent Seven, meaning more stocks participating in the advance of the stock market. And history has been such that if you want a sustainable move in advance in the stock market, it needs to be accompanied by wide breadth, meaning a high percentage of stocks are participating in the advance. So now back to our chart. So the S&P was up 26. That's the purple line. Looking at the rest of the indices, we've got the orange line, which is the Russell 2000. Those are small company stocks. They were up almost 17%. The red line in the chart references foreign stocks. Respectable, they were up 16%. And the blue line, that's U.S. aggregate bonds. It's kind of like the S&P 500 bonds. It was up 5.6%. And we've had many discussions with clients, within the advisors, with Doug and Dan. I think after 2022, most people wanted to ditch bond investing after that year. And I get it. The bond index lost more than 13% in 2022. It was a rough year for bonds. And from that pain, though, that came an environment where you now can earn actually a much higher returns on bonds, as well as cash and money market funds. And you see that with this green line. So money market funds were up over 5% in 2023. And It's been a good 15 plus years since we've had a time where you could earn a meaningful rate of return on bonds and money market funds. And fortunately, that's the environment that we're in today. Now, while 2023 turned out to be a pretty good year, it wasn't an easy path. I mean, if you can look at this chart, I mean, most of the year saw the stock market go up, then come back down and go up and come back down again. Outside the big tech names, many stocks were slightly up, negative, or flat by early November. And that can be said about bond investments as well when you're looking at this chart. So the market really was not making traction for the majority of the year. Then from early November to the end of the year, stocks and bonds both came alive, with the majority of the stock and bond moves coming in just under those 2 months. So you had great results, but it was not an easy path to get there. So what propelled the market in the last few months of the year? Moving on to the next slide, inflation was certainly a big driver of that. Now, there's several contributors we can look at probably for the year that really helped drive the market up, but certainly one of the biggest contributors was the rate of inflation coming down. The U.S. Consumer Price Index year over year is now at an inflation rate of 3.35%. That's well off. You can see it was well north of 8% back in 2022. The average U.S. Consumer Price Rate Index over the last 23 years was 2.56%. And whether you looked at food, you exclude food and energy, which is the U.S. Core Consumer Price Index, all have dropped significantly over the last 18 plus months. So to be in a position where inflation's come down dramatically, no recession, which could have resulted in substantial job losses, the Fed is now able to change course and, in fact, may reduce interest rates during 2024. And that was a big driver of the move in the market last year. As a stable economy with a solid labor market, you're likely to see corporate earnings rebounding in this year. And if you want to look at one particular driver and one only that has the strongest correlation to what happens with stocks, it's earnings growth. Stocks moved up in anticipation of earnings growth rebound here in 2024. So let's move on from inflation. Let's move on, look at the impact of interest rates. So where are rates now? This chart doesn't really capture, I think you had to zoom out probably a bit more to capture where rates were maybe a couple of years ago when they were down between 0 and 2%. But with short-term rates now, you can see depicted by the 3-month Treasury bill in orange, it's over 5%, which is pretty attractive. And the rate that will come down if the Fed goes down the path of cutting rates is going to be directly correlated, I think, with that 3-month Treasury. You're going to see it go down if the Fed cuts rates. As you can see with the 10-year rate, that purple line, it's still much lower than shorter term rates. And you've heard the term inverted or inverted yield curve, which has been the case for a while. That's still the picture that we have. The 10-year Treasury rate, though, it peaked around right in the early part of October. You can see in the chart, it was probably around 5%, which was near the depth of the downturn of the stock market back in 2023. And there were a number of stories that were coming out at that time saying that interest rates were going to be higher for longer, which could have posed serious risk of really slowing down economic growth. Unfortunately, inflation data really continued to come down, improve, and you can see the 10-year rate dropped as well. And then you had the big surge in stocks, and that coincided with that drop in the 10-year Treasury rate. So before we move on to the next slide, though, have you ever heard of like the term flashback in a film? So a flashback is it's an alteration of a story order in which the plot moves back to show events that have taken place earlier than the ones that you've already experienced in the film. So imagine that we're in one of these movies and where you watch a scene and then the movie rewinds to an earlier point. The movie then starts from there and works its way back up to that scene, which helps provide context. You know, I enjoy movies that help with that storyline. And so the reason I'm bringing this up is we just talked about 2023, which was a great year, but let's employ a flashback and move back in time to late 2022. So what was going on in late 2022? Inflation felt out of control. It was extremely high. The Federal Reserve was late to the game and starting to raise interest rates, but what now was on an aggressive trajectory of raising rates to slow down inflation. and the stock market had been down by anywhere from 25 to 40%, kind of depending on the indice. So Doug, all right, let's with this prediction slide, I think this gives people a pretty good picture. And really what you were seeing is recession. And pretty much every economist was predicting a recession during the next 12 months. And there's a strong correlation between the stock market and the economy. A natural question, I think, for a lot of people probably could have been is, why would you be fully invested in stocks if you're headed for a recession? And that's a fair question. And while there were risks, we didn't add up at that time, but what the job market still was incredibly strong, and people were still spending money and supporting the economy. And those things together really don't align yet with an economic recession. So there's several more factors that you have to consider, but that level of strength in the labor market and spending just didn't align at that time. So this is where you see negative headlines after negative headlines coming out about the economy and the stock market, and that can put incredible stress as an investor. I mean, research shows that the pain of loss is twice as powerful as the pleasure of gain. So let's shift a bit. I'm going to introduce the idea, and Dan's going to expand on this a little bit more later with some examples, but we're going to introduce the idea of behavioral economics. So let's take a look at this picture now with the frying pan you have here with you're seeing with the egg. Remember this ad? This is an ad. I don't know if anybody remembers this nostalgia. It's from 1987. So if you remember this ad, there was a man holding an egg and he was stating, "This is your brain." If you saw the commercial, you remember the rest. And he says, "This is drugs," as he points to a frying pan. And then he cracks the egg and puts it on the frying pan and says, "This is your brain on drugs." And then the man says, "Any questions?" It was a public service announcement, the Partnership for a Drug-Free America, if you remember. All right, so let's move to the next slide. Why are we talking about this, and why are we talking about your brain? Well, your brain weighs about 3 pounds. It's thousands of years old. It acts as a dynamic, opportunistic, self-organizing system of systems. It contains 200 billion neurons, has a larger cerebral cortex than most mammals, and a very highly developed visual system. MRIs now have revealed to neurologists what our brains look like when we're making decisions, and we can observe it in real time under actual conditions in reaction to financial risk, reward stimuli. And once we begin trading stocks, however, our brains begin to undergo subtle change that we can actually see on the MRI of traders. So Doug, yes, look, we've got Homer Simpson's brain here. This is your brain on stocks. It's also the source of almost all of your investing errors. And I mentioned earlier, this fun exploration of behavioral economics, the study of the financial decisions we make, what goes on in our brain whilst making those decisions. So Dan's going to review investor behavior, noting some of the common investing errors and how and why these occur. But first, before we do that, Doug, we're going to shift to you, talk a little bit about 2024. Then we'll get back to Dan and talk with him a little bit about investor behavior. So,
Sure.
Doug,
Yeah,
take it away here about 2024.
Yeah, I mean, poor Homer Simpson here. He's being stereotyped as a poor investor. I've never seen any Simpsons episodes where he's giving stock recommendations, but sure enough, he's the one who gets the small brain in this situation.
It would probably be the typical,
Yeah.
response, I'm sure, most of the time.
Obviously. So, so as Casey went over a pretty comprehensive recap of 2023. So we're going to go over some charts now that could possibly paint a picture of what 2024 would look like. I would say on the whole, they're fairly optimistic. A lot of historical context that I think you're going to hear throughout the year. I think they say that history doesn't necessarily repeat. But it certainly rhymes, and I think that echoes a lot in some of the charts that we're about to look at. So everybody knows that November this year, there's a presidential election coming up. If you didn't know that, you will know it soon. You're already seeing the headlines left and right. We will save some of the election charts for future webinars, because I know those questions will come up. But This is one of the themes that I think investors should pay attention to, regardless of what your feelings are about either candidate. But this chart shows the 4-year presidential election cycle. This first version of it is broken down into each year. So you've got the post-election year right here, which would, in this case, as we start this over, or I guess we could look back, this is going to be 2024, 23, 22, 21. So this goes back to 2021. So the first year after a presidential election, you've got a blue line, which takes an aggregate of all the historical instances of this taking place. So pretty solid year in terms of what history does. This is what the market actually did during this 4-year cycle. So a very good year in 2021, not so great in 2022, but then we see a big historical bump up in the last 2 years of an election cycle. We certainly followed that last year, and then this year could provide a similar tailwind with the last year of the election cycle coming up. Now, if we zoom into this a little bit, we can see where we've come up to, I think this is through January 17th. So, kind of following in line with what has historically been a very good year for that last part of the cycle. And what it says here is the trend is more important than the level. So you may hear a lot of talk now about all-time highs, and because we're at all-time highs, we can't go higher. But that's not necessarily true. And we're seeing some strength coming in to the beginning of the year. And I think there's a lot of things this year to like about the ability for the market to continue to grind higher. So if the S&P 500 were to follow the historical election cycle here, we would expect to see pretty strong gains throughout this year. Now, another way to consider this is if the S&P is up, or if in year 3 the S&P was up 20+%, it's been up 100% of the time in year 4, based on a historical context. So all the instances of this goes back to 1935. You've got 35, 95, 75, 2019, 55, 2003, 91, 2023, and then 1967. So here are all the year 3 returns. So if we look at 2023, roughly 24% last year. This number remains to be seen, but if you look at the average and the median, both of those are in the low double digits. So some pretty solid numbers here. Whenever we see some kind of historical instance that has 100% success rate, doesn't guarantee anything, but it certainly shows some strong data there and some belief that we can continue this trend going into 2024. And then you've also heard, that the market has hit all-time highs, but you'll hear some strategists say, well, now we're at all-time highs, we've missed the boat, or stock prices are too high. Whatever you want to, consider to be your cautious mindset. If you look at the returns from new all-time highs after bear markets, they're still very substantial. So this goes back to every bear market we've had since 1957, shows the decline, where the trough is, and then the date where we actually hit the new all-time high, and then the subsequent returns after that point. So there are some red numbers on here, but there's an overwhelming amount of green numbers on here. And even with the worst data set here, which was coming out of the tech bubble, 5-year return of -4.5. Look at some of these other returns. You've got 2 instances of over 100%. You've got 86 coming out of the great financial crisis. So again, this is kind of a similar setup that we're seeing right now. We had our bear market in 2022. We've now just broken through all-time highs as recently as January 19th. So historically, the return setup for those situations has been pretty positive. Now, everybody knows that the Super Bowl is coming up here on Sunday. This is kind of it's somewhat of a tongue-in-cheek chart, but again, it still, tells a positive story for 2024. So this shows how the market does in a year where every specific team, or at least teams that have won the Super Bowl, how the market has performed in those years. So we can look and we can identify the two teams. So we have the San Francisco 49ers. When they have won the Super Bowl, the average return has been 19.2 in that year. When the Kansas City Chiefs have won the Super Bowl, the average return has been 13.5. So if we were to go just based on this, our work is done for the year, go by the S&P 500, and we're finished. Now, with that, I would say you don't want the Rams, the Dolphins, or either the LA or the St. Louis Rams. Man, I don't know what it is about the Rams, but whenever they win the Super Bowl, bad years in the market. So, granted, little tongue in cheek here, but certainly some interesting data as well. So we've shown a lot of kind of historical analogs, but what ultimately really is going to drive the market, as Casey mentioned earlier, it's going to be earnings and it's going to be economics. So do we have those things along with some of these other kind of anecdotal stories? And I think we do, at least for the time being. So this shows the S&P 500 calendar year actual returns and then estimates. So this goes back to 2014. Bar charts, you can see here there's flat, and then we got a progression up into 2022, and we kind of had a flat to slightly down year going into 2023. But since then, we've seen a little bit of an inflection here, and the estimates going forward are pretty robust. The expectation is for low double-digit earnings growth through this year. And if the market can stay, or if companies can hit those numbers, that certainly provides a backdrop for stocks to be able to continue to perform well. So you see the estimates into 2024 positive and into 2025 are positive too. So you've got that earnings component there. Now, companies actually have to perform and hit those numbers, but to see those estimates so robust, I think is a good sign. And then from an economic standpoint, GDP growth continues to trend positive. It's actually come up a little bit in the over the past few months. Now, below 1.5% growth is not great, but it's also not recessionary. And I think at this point, if the U.S. can avoid going into recession, that's going to be a very important item in order to drive stock prices higher through this year and going forward. Now, some of you may have noticed, and we'll get to this at the very end, we've recently reduced our international exposure a little bit more. And here's a good example why. You see both the Eurozone and Japan, which we don't directly invest in, but can be a proxy for developed international economies. You can see that the U.S. has overtaken those, and these are still trending lower. So good economic growth forecast, or non-recessionary, we'll call it, and then good earnings potential as well. So those two things combined with a lot of anecdotal stuff, I think paints an optimistic picture for what stocks can do in 2024. Now, we talked a little bit about in one of the titles of the piece were how much cash is too much cash? Well, I'd say that's kind of a trick question because I don't think you can ever have too much cash. But as Casey showed with rates moving higher, there's been a flood of money into money market assets to try to gain that 5% return that we haven't seen for roughly 15 years. So exactly how much cash is in money markets right now? Almost $6 trillion of cash right now in money market funds. So how does that compare? Going back to the great financial crisis, it is easily at the highest point we've seen. And this is the line where the Fed started to raise rates. So you can see an influx of cash has certainly come in. Now, why is this important? Well, there's a few different reasons. One, when you have all this cash on the sideline, if returns start to really outpace cash rates, and when stocks are up in the mid-20s, cash rates are 5, some investors might look at that and say, hey, you know what, maybe we feel like we want to get back into the market, take a little bit more risk on our portfolio. So there is a mountain of cash waiting in money market funds to come back into the market at some point. Now, whether or not that's chasing returns or simply, adding fuel to the fire that's going on right now. I think that's yet to be seen, but that's certainly something to keep in mind as we move through, that there is a lot of money potentially that will come back in. Now, the other aspect of this, and we've started to talk to clients about this a little bit, is cash balances in most of our clients' accounts are at the highest levels they've been in quite a while. And we've done that intentionally because cash rates are very good. They're very comparable to bond rates. But what you've started to see and hear from the Federal Reserve is the idea that they are going to begin to cut rates at some point this year. Now, there was a Fed meeting yesterday, and there was a pretty high probability that there was going to be a 25 basis point rate cut at the meeting yesterday. In fact, 1 month ago, that stood at about 73%, right? So the Fed kind of dumped some cold water on that yesterday and said, we have no intention of cutting rates at this meeting. So all they did was they pushed out those rate cuts, possibly starting in May. And the consensus is for anywhere from 75 basis points to 125 basis points of cuts throughout the year. So the probabilities dropped a little bit, but then if you look towards year end, so this is a year end projection on January 29th. This is a year end projection the afternoon of the Fed meeting. You can see that the probability of this being between 375 and 400, or 3.75 and 4% on the cash rate, doesn't really move a whole lot. Okay, so what that says is, yes, they may have pushed this rate cut off, but the expectation is by the year end, cash rates could be as low as 3.75%. Now, why is that important? It's still a good return on cash, but we need to start thinking about tactically moving some of that cash back into the bond side while rates remain high, for the potential to lock in some of those income streams at higher levels for longer periods of time. So for instance, I believe that the 5-year treasury rate right now is right around 4%. So you may look at that and say, okay, well, 4% is not 5%, so why would I move it? Well, in 2 years, if the Fed has to cut rates to 2.5% or 2%, that 4% that you have now locked in for 5 years is going to look pretty good compared to a cash rate of 2%. So we're certainly not suggesting that all of the cash should go back into the bond market right now, but we want to start getting clients comfortable with the idea that it may be sooner rather than later that you start to see those cash rates moving lower. And we really want to be tactically opportunistic with putting some of that cash back to work in certain areas, whether it be equities or fixed income. And then, if the Fed does cut rates, it's historically been a good thing within the context we're seeing right now. So this is the S&P 500 performance after the Fed cuts, within the market being 2% of all-time highs. So this goes back to 1980, and you can see this box is a little bit small, so I'll try to read these numbers out. But in those instances, and these little green dots represent those times, you can see there's a lot of up and to the right movement with these clustered dots. The average 6-month return after an instance like this is 3.8%, with 75% of those instances being positive. But then you go 1 year out, average return of 14%, 100% of those instances being positive. So again, another historical analog, but you have a lot of these analogs lining up right now to support continued strength in equities going through 2024. So we've covered a lot of optimistic data points right now. So Dan, behavioral finance is, I think, a topic that we probably don't talk about enough, but can be very, very relevant in terms of making sure we're not making emotional decisions and or mistakes in our portfolio management style. And I think, clients can relate to a lot of these, whether or not they understand that they've done these before. I think we'll probably have a lot of people nodding their heads saying, oh yeah, I see that, or I get that, or I understand that. So we've got a very simple chart on the screen right here. Why don't you explain to us what the behavior gap is.
Yeah, absolutely. So a lot of investing is a lot of psychology. So it kind of goes hand in hand to really talk about these things when we're going through market pieces. So the behavior gap is essentially the gap in returns between an investment, whether it's an ETF or a stock or a portfolio, and an investor's actual return. There's been a lot of studies on this. They get updated by Vanguard just about every couple years, and it shows that the average investor and even professional investor tends to underperform the one thing that they're investing in because of behavioral mistakes that they make along the way. So this is something we're very, cognizant of, and we always take all of our biases and psychology into account when we're making decisions, because we want to make sure that we're getting a full investment return, and not letting fight or other kind of psychology get in the way of our investment decisions. So I'm just going to go over a few biases and mistakes that investors make. First one that a lot of investors make is recency bias. So a lot of people like breaking down their investment returns by year. Well, this year, next year, last year. But in reality, the market doesn't really care. It doesn't work on yearly timeframes or monthly timeframes. So sometimes it's important to kind of zoom out and get the full picture of things. So an example of this is on this chart. So the purple line there is the Vanguard Mega Cap Growth ETF. The Mega Cap Growth ETF holds the largest, not even large cap funds, or not even large cap stocks, mega cap stocks. So we're talking Facebook, Apple, Amazon, Microsoft. And as you can see on the chart, Mag 7 last year has been the story. It was up almost 46% in 2023. And then another position on this chart is SCHD, the Schwab US Dividend Equity ETF. So this fund essentially invests in companies that have solid, stable cash flow. They pay a stable dividend. They're more on the value side. They grow their income. They're very strong companies in that stock. But I mean, if you're looking at this chart, you'd say, wow, I really want MGK. I really want tech. It's the only place to be. Why do we even own this? And you look at this chart and you say, well, why do we even own SCHD? But if we zoom out a little bit and look at kind of a full market cycle, this is not us manipulating data. This is literally just the start of January 2022 to today. Orange line being SCHD, purple line being that MGK mega cap growth. If we strip out our recency bias and look at the investment returns of these funds over this full cycle, we get a better picture of what's really going on. It could have been that, these large cap names were really just recovering because they were beat down the year before. It could be that, this SCHD fund is performing poorly this year because in reality, it's just a stable fund that grows its value more slowly over time. So when we're looking at investing in a portfolio, we have to really make sure that we are zooming out, not taking in the hot stock of the time or the new trend. We really want to zoom out and make sure that we're taking in the whole picture, not just focusing on 1 year, not focusing on 2 years, but sometimes looking at kind of the fundamentals of the fund to see why we own it and if it's a good fit. So the next one is framing. So we've talked about this a little bit earlier in this presentation. The S&P 500 right now is at an all-time high. The NASDAQ at an all-time high. The Dow Jones is even at an all-time high. And you look around, a lot of people are saying, well, the market's gone up too fast. The market's overvalued. It's time to sell. It can't keep going up. But in reality, if we look at the S&P 500 forward PE ratio being the price to earnings ratio, over the last, few months, or actually longer than that, over the last year, the S&P 500 from a valuation perspective, even though it's back at an all-time high, continuing to make new all-time highs, it's actually at a better valuation than it was in 2020 and 2021. So, I mean, we still held stocks during those times too, despite how the valuation was there. Why wouldn't we hold them now? In 2022, the S&P 500 returned about 18%. In 2021, the S&P 500 returned about 28%. So now we're sitting here at all-time highs, and we're worried that, the market's gone up too fast, things are overvalued. But in reality, we're looking at a more favorable valuation now than we were back then. This chart is actually really interesting. Casey sent this over a few days ago. And this is essentially all about the media. Who's telling you that the market's at an all-time high and it's too expensive? Well, it's the news. I think all of us probably had an idea that this was the case, but seeing this visualized kind of actually blew even my mind. And I'm, a little bit of a cynic about this type of thing. So this chart shows the average yearly sentiment of news article headlines in 47 popular news media outlets. So as you can see, this chart goes back to 2000. The sentiment and negative headlines have continued to get more and more prevalent as we've gone on. And it's at, an extremely low level at this point. I mean, you're looking at the dot-com bubble busting in 2000. You're looking at the great financial crisis when unemployment was north of 10%. Businesses were closing, people were losing homes, and yet the news was rosier back then than it is today. Especially the financial media, it's very tough to bring up CNBC and find something positive. And the reason for that is, if you're worried about your money, if you're worried about your portfolio, you're going to be a lot more tuned in to what the news is telling you, what articles are being put out. And I mean, it's not about helping make you money. It's about getting your views, getting your clicks. So sometimes it's a good idea to kind of step back from that, look at, all these, media outlets through a clear lens, and make sure you're not letting it influence you and bias you a little too much, because you have to realize that they're a business and they really just want your eyeballs and they want your clicks. So when we're investing, we got to make sure that we're looking at the data, we're looking at the hard numbers, and not, who's on the news that night telling you about XYZ. So next, we're going to talk about the disposition effect. This one is pretty interesting, and a lot of people don't really know about it. And I think it's good for us to talk about. So the disposition effect is essentially data that shows that investors are more willing to sell their winning investments than they are to sell their losing investments. We've bought things over time, and if they don't end up working out, we'll end up selling them, and sometimes at a loss. And we always get questions about that from clients. Oh, well, why did you sell this at a loss? Why didn't you sell something else? But data essentially tells you to make sure that you're holding on to your winners and not adding to positions that are no longer working. Peter Lynch has a famous quote that's quoted pretty often. It says, selling your winners and holding your losers is like cutting the flowers and watering the weeds. So essentially what he's saying is, if you have investments that are working, cognitively, we're more likely to sell those investments because we see that as a gain. We're taking a gain rather than losing investments that, we bought for whatever reason. The thesis might have changed. In reality, we should probably sell those positions, but we don't feel as good because we're booking a loss. Data actually supports it too. So if you go and sell winning stocks instead of your losing stocks to fund an expense or something like that, data shows that over the next 12 months, the winning stocks that you have trimmed at a very high percentage of the time outperform the stocks that are not working, or your investments that are not working at, I think it's a 65-70% clip. So we have to make sure, if we're holding on to an investment, we cannot be afraid to sell it at a loss, because there's an opportunity cost. Each time we're holding an investment, we want to make sure that it's working in the way that we intended for the portfolio, for your portfolios. So we have to make sure that we're holding our winners and not subsidizing our losers. And then overconfidence. So this is a pretty well-known trading study back from 1999. It still holds true to today. The data does. We've had a lot of clients talk about 2023, and we didn't really make that many trades. Now we did make trades, but we weren't very active in 2023. And some people equate trading to making more money, because then we're actively putting money into new ideas. But in reality, it can have the opposite effect. So this chart basically says portfolio returns for most and least active traders. The 20% least active traders in this study had a mean monthly turnover of 19 basis points. That's less than 1% of your whole portfolio being turned over in a month. That's not really trading anything whatsoever. Their average annual portfolio return was 18.5%. And then the most active traders in this study, it was a large study in 1999, the mean monthly turnover of those most active traders was 21%. So say you have $1 million portfolio, you're moving $200,000 of money around every single month. Their average annual portfolio return was 11.4%. So, we meet every single week. Doug and I look at all of our positions holdings daily. We sometimes meet more than once a week if there's headlines. We are looking at all of our positions every single time, and every single one by one. If they're working and doing as intended, we're not going to try and overtrade them or go in and try to make something happen that's not there. So sometimes in years when we really like where our portfolio is positioned, we're not going to place as many trades, and that doesn't mean that performance is going to suffer. It just means that we really like the positions that we own. So overconfidence being the last bias that we'll talk about today. It's just something, all of these together really kind of cover that behavioral gap. And we just want to make sure that we are not making any behavioral mistakes. We're taking care of your money as well as possible. And this is definitely something that's on our minds all the time.
Thanks, Dan. So to kind of wrap this up, let's talk a little bit about current positioning. So we are still overweight equities. And as I mentioned earlier, we recently increased our U.S. exposure along with our quality factor exposure. So you've probably seen some of those trades over the last few weeks. We're still holding large cash balances. The economic path is obviously going to determine what our next moves might look like. And we're going to continue to look for tactical opportunities to deploy that cash. As I mentioned earlier, if the Fed begins to actively cut rates, that is going to bring the cash return down. And we want to make sure that we're not too late on the opportunity to redeploy some of that cash. And then we talked a lot about all the good things. We don't want to seem too over optimistic. So what are some risks that are out there? The biggest one, I think, is that the economy slows into recession. Casey showed that chart earlier that talked about the percentage of economists predicting a recession last year, and it was close to 100 or 96. If you saw that same study, my guess is the number is still pretty high. A lot of people believe that the lag effect of the Fed's rate hikes have to catch up with the economy at some point. And the worst case scenario in there is a recession. So we're certainly staying on top of the economic data points that we pay attention to that we feel like would indicate the concern for recession. But as of now, we're just not seeing that playing out, specifically in both earnings and employment, which, in my opinion, are the two biggest components of that piece. you've had a narrow market, or there's been heavy market concentration. The Magnificent Seven represent a very large part of the overall index. Historically, coming out of periods like that have been a little bit turbulent and or negative for the market. So if we can get a little bit of broadening out here with small, mid, some of the value sectors participating a little bit more, I think that would help to take care of some of this market concentration. But it's certainly not something that could be completely ignored. Geopolitical tensions, obviously you still have situations in several parts of the world that have kind of been simmering for a while, and if those were to boil over or flare up, that could cause some disruption to markets. And then finally, economic and or earnings projections being too optimistic. The Wall Street analysts are notorious for taking earnings revisions and quietly revising them lower and lower and lower and lower. Number comes in, they declare a beat, but in reality, it wasn't a beat based on the initial forecast. And there's a little bit of a game there to be played. The current consensus, as I mentioned earlier, 2024 earnings low double digits. We're hoping that number is not too high, and or GDP growth continues in the low ones or even the mid twos and doesn't breach that 0% number that's historically been in the recessionary territory. So one last thought. Went too fast there. So we've talked a lot about behavioral stuff. We've talked about some analogs in 2024, some risks, but the reality is investing is a long game. And we spend a lot of time going over performance reports, and almost every performance report that we're going to go over with clients over the next few months, or that we've already gone over with clients, is what was my 2023 return? And we tend to focus on very short time frames just because we're hardwired to do that. But this is truly a game where time is on your side. And you can look here, and this is the percentage of time that you've had positive returns over different rolling time periods. And over 1 month, the S&P 500 up 60% of the time. So it's almost a coin flip. It tells you there's some volatility. It tells you there's some uncertainty when you're looking at things in that short a clip. Even if you go out to 1 year, 73%. So 3 out of every 4 years, 3 years, 5 years. But once you get out to 7, 10, 15, 20, you start to see the odds really turning in your favor. So, we want to spend a lot of our time focusing on very short time frames, but I think it's important for everybody, clients, advisors, even the people in the investment committee, to take a step back and understand that when we stretch out that time frame, the odds of having positive performance are, I don't want to use the word guaranteed, but having 100% probability over 15 and 20 years is a pretty powerful number to look at. And yes, there's going to be adjustments along the way. Yes, there's going to be bear markets and 10% corrections in there. But for the most part, if we can generally just stay the course, stay invested, and be cognizant that time is on our side, I think that's gonna lead to success more times than. So Casey, I'm not seeing any questions here, so I will let you go ahead and take us out.
Well, that will be a wrap. So thank you very much, everybody, for being with us. And thank you for the trust and confidence that you've placed in HCM, wealth advisors, and CPAs. Please don't hesitate to reach out if you'd like to discuss your individual plan. We are glad to help. And if there's a family member or friend that we can help, please reach out to provide an introduction. We would be honored. Thank you again, and have a great night.